Hello, everyone. Welcome to today's webinar. Michael Madden with you. Great to have you all with me, and thank you very much for taking the time out of your busy days and busy week schedule to have a listen to what I have to say. So, I'm going to basically continue on from a follow-up from basically last webinar we did, which was back in February. Doesn't seem like that long ago, the first week of Feb, and we did a webinar titled "The US Dollar on the Crest of a Powerful Wave." So on that day, I had a very clear message and began with my trading philosophy, which I generally do when it comes to these webinars and my teachings. But as a practitioner of the Elliott Wave principle, I see myself as a discretionary pattern recognition trader. So we get to see patterns. We believe that the stock markets, financial markets in general, are patterned, and then we have the discretion then to take trades or consider trades against those on any time frame, and any pattern that gives us information, and often the trading setup. And I often like to quote in the words of Paul Tudor Jones, where the reward to risk is ridiculously skewed. So we want to see something that's given us reason to take a trade against it. And I would normally think of something that is a 3-to-1 or above. So we often see 5, 6, 10-to-1, etc. We kicked off the webinar just with a breakdown of the Elliott Wave model. So I'm not going to go through the ins and outs of that. We can look back on the last webinar if you haven't already done so. Of the 5-wave structure, 3-wave corrective pullback. We located a price chart of which we all found out that this was the dollar index on a monthly time frame. And then we were able to highlight the similarity between the Elliott Wave model, this compound construction of 5 waves up, 3 waves back, how it resembles the price action here within that index. And then after adding some labels to the price chart of the monthly index, the monthly chart of the dollar index, we labeled an impulse to have peaked at 114.78, that being the 5-wave part of that wave model. And from that peak, we're looking for a 3-wave pullback to unfold, and that will complete then the Elliott Wave model that we would work with. The daily chart that I highlighted shows this overlapping price action into the 110.18 peak, and we were able to recognize that as an ending diagonal pattern within the patterns of the wave principle, and that ending diagonal was completing wave C of what we were labeling a flat pattern for this red wave B. And at that juncture, the key level offered would be 109.88, as in, if wave C is peaked, and if this market was going, 110.18 would have to remain intact. And down on the daily chart, we had a lower swing high at 109.88. We highlighted the extended boundaries of the diagonal, because with the diagonal pattern, triangle patterns, channeling at all time frames, I like and I encourage people to be very precise with the application of those trend lines. And then when you extend the trend lines into the future, we can often get levels for support and resistance, and also the apex of these lines when they cross often give us an area where a pattern may complete, or we could get a period of volatility. So depending on the wave pattern that's unfolding as price action may cross that line, that vertical line, we can be aware of that. So there's information constantly being given to us that we can use. So this was all pre any price action unfolding. And as we said, we were looking for price action to get lower. And of course, we had this lovely chart here where the guy is about to go surfing this monster wave. And that was kind of the title, where we were looking at a C wave basically to unfold. And this being a monthly chart, this be quite a significant turn down in the US dollar. And anytime we see a pattern that is completing or has complete, or we're looking at a price chart, it is a case of going, well, how can I surf that? How can I be part of that? Or what do I need to ask myself? And while analyzing the financial markets at times, it's not always easy. There are periods of difficulty where you're dealing with the corrective pattern, the internals of a B wave, and you've got X's and Y's and stuff. But at the end of the day, you try and keep things simple. And then when when the pattern does reveal itself, of which it always does, well, when it's revealed, then you can say to yourself, rather than me messing with when I'm not seeing stuff as clear, when I have a clear pattern to work with, do I have a reason to enter the market? Do I know where I'm wrong if that is the case? And then where is the market going? Have I got a reason for that market to be going somewhere? So that is the basic elements of any trading plan. And you'd often hear some good traders say, well, if you can't write your plan on the back of a bear mat, you're too complicated. Like, that's not to say now you can't start adding more, nuances to how you're going to trade the markets, or what you're going to do once trade gets going. But they're the basic premises of anything. And that's where we're going to present it on multiple junctures at multiple time frames with the wave principle. So the questions that we could answer then would be like, we need an entry, a stop, and a target. So here we can see that the entry could be at the where price action was trading basically at that day. We knew we were wrong if price action gets above 110.18, because if that happens, well, the ending diagonal hadn't completed and wave C had not peaked. And that's a fact. So we need to deal with facts when we're trading. But the forecast for wave C is get below 116. And then we highlighted some downside targets or projections, or even some wave principle guidelines we'd be looking for a price action to adhere to. We'll go through them now in a minute also. And just to work out a basic trading plan from those figures, so you can know if you enter the market at 107 and your stop is at 110, well, the risk is $2.57. And then if your market is to get down towards 89.20, which would be the low of the previous fourth wave, or even 96.22, you're looking at 4.5 or 6 to 1 reward to risk ratios, which is, pretty good. And that's pretty extreme when it comes to like looking for this type of market action. So now we're on to the updated chart of what did happen. And on your left is the monthly chart of the dollar index. And then on the right is the ending diagonal, and then the swift and dramatic reversal. So that's the guidelines that we would be expecting with the diagonal, of which you talked about in the last webinar. And also the extended boundaries of the diagonal and the vertical. You can see where it did coincide with the completion of a correction as we rallied over or through that apex. And then we got a swift decline from there. So a period of volatility that actually coincided with the pattern completing. We highlighted this in real time on the pro services, but ultimately the forecast was in place for what was unfolding, or what basically has unfolded. Most importantly, against that key level. And you can see price action now dropped nice, impulsive price action to the downside, corrective rallies, brief corrective rallies, as in they're not deep, drawn out. That's a sign of underlying weakness. And we see price action on each of these turns then continued to push lower. So now, if we get onto some of the labeling within the decline from 110, we can see that we're counting 1, 2, third wave possibly in place, and then a corrective rally back to 101.98. And the message with the price action from 97.92 is that it's very corrective in nature. We're not counting this as 5 waves. It doesn't fit the model that we just looked at the early stages of this webinar, where we had 5 waves up, 3 waves back. This is a 3-wave structure, which is part of a downtrending 5-wave decline. And it's a counter trend move in what we feel is a still unfolding impulse from 110.18. So under the guideline of we've dropped our key level, etc., we've gone from 110.18 to 101.98. So from here, we're looking for 5 waves to unfold and to take price action below 97.92. And with the wave principle, then we're able to establish projections for where wave 5 may potentially end. So we take the distance in wave 1, we extend it from wave 5. If we extend wave 5 equals 1, it doesn't get below 97.92. So in real time, we're not going to consider a truncation occurring. And then we have the distance traveled from the origin of the move, 110.18, all the way down to the end of the third wave. So you take that full distance, and you extend it from the end of wave 4, and 0.618 times that gives us a projection at 94.40. And also we can take the golden ratio, where we take the distance traveled from all of the wave and see where wave 4 would divide the pattern into the golden ratio. So 38.2% retracement, and that comes in at 96.95. So close enough to the 95 would be considering that to be a cluster. And then if wave 4 was to divide an impulse into 50-50, which we sometimes see, it would occur at 93.86. So the message here is the wave is still unfolding to the downside, the monster wave we were looking for, and there's still potential for ongoing weakness. And we will continue to favor lower. We've established an impulse channel, and we expect the price action to remain the lower boundary of that channel. But we also know that if price action does rally above 101.98, going by the right look, the guideline of the right look, it is unlikely that wave 4 is going to continue to push higher. And if we were to violate this key level, well, we would have to start considering some other scenario. And going by the corrective looking price action from 97.92, I'd be more inclined to consider this to be a wave down following by a corrective rally and look for another wave down. As in other words, this could be all of the first wave and not a still developing impulse, and then this could be a corrective rally. But I'm not even going to go down that line because that price action is not warranting that much time or effort to go looking at that scenario, because everything is playing out as we're looking at the moment to. So don't be kind of going down, what if this, what if that. If we get a breach of that key level, well, that's what we'll do then on that. And we'll think about that then. But if we get back to the monthly chart, get back to what I'm more concerned about, this higher time frame price action, and get back to like what does it mean for the dollar index and maybe some of those pairs. The message I'm trying to say is I don't think we're at an area where the index is expected to bottom, going by the high wave degree pattern that we're working with. So going by this being a 5-wave structure and this being a corrective pullback that's unfolding, I'm expecting at least a breakdown from the impulse channel, as we discussed in the last episode or the last webinar. And also, we've only tagged the 38.2% retracement of the whole distance for purple wave A. So this is a very shallow pullback, and it's within the impulse channel. So I'm not considering it to be anywhere near satisfying the correction of the 5-wave structure, like we saw in the first slides there. 5 waves up, 3 waves back. With the quality projection for wave C at 96.22, but also a strong guideline is that following the 5 waves, we would expect to pull back to the low of the previous 4th wave at 1 lesser degree, which comes in at 89.20, and then more like a corrective pullback to get back to the 61.8% retracement. We're talking about 87.53. So getting back to the 80s is, quite a significant pullback, as we're currently trading at just basically the 100 handle. So we're investigating that, and we're basically opening door for ongoing weakness. But even if we were to take this to another level and say, well, if this 5-wave rally was more than something else, or what could it be? We need to go out again. And I went into the archives of the wave of EWI's vaults there recently, and I've been pulling out some very interesting charts. And a chart and a book that I got my hands on was a book that used to be published by the Foundations for the Study of Cycles, which is an organization that's still in operation, and they still work. But I'm not sure if they are still updating these kind of charts and stuff. But I did a bit of work here, and I thought that this was a very interesting chart, and I got some, very interesting and long-term charts that I said, I must look at this price action and see where it might be in the context of some of the wave counts that we're working with. So this is going all the way back to 1660, and the last bit of price action here then is 1995. So when I saw this chart then, and I saw this beautiful 5-wave structure from 1860, it just looks like beautiful surge higher, and straight away I was looking at it and said that's a certain looking 3rd wave anyway. And I hope that's what everybody here was kind of considering that too. So, but what I needed to do then was do some homework and see how could I get the price action and maybe add to this chart. And so what I did was I went to get some data, and I went to TradingView, which is trading platform that I think everybody can get their hands on really. But they had the data for the dollar index. So this on the right hand side, this is the quarterly data. So basically it's a line chart, and it's got all the quarterly data. And then this here then on the left is the 12-month data. So it's just like going in and out of time frames, like going from a weekly chart down to a daily chart, down to a 4-hour chart. You go out to these very, very high time frame charts, and it's the very same. So this chart here is made up of yearly ranges. So, and then this chart then is made up of yearly ranges too. So what I said to myself then, if I was able to line up, or I wanted to see first if the price action did line up. So when I got the trading view data and I got it to scale with the this chart, and I saw that it actually lined up quite nice. And I said, well, this will give me some nice information. It'll give me more information with regard to the higher wave degree patterns that we're working with on our weekly and monthly charts for the currency pro services and for GMP. And I thought it very interesting that if we were to put a wave count in here, would it give us some information on where the dollar may be, in the context of where this correction could be going to or what's happening next. So the next thing for me to do here then would be to put a wave count on the price action. And what I did was I considered this to be a wave 1 up, a 3-wave pullback for wave 2. And then, of course, I thought there was no other way to count this, only this to be the 3rd wave and the peak of a 3rd wave, and then favor that wave 4 was unfolding. So all this price action that we've been looking at from this move back from I think it was a 1985 peak, we're favoring that this is the wave 4 correcting, that would be in a similar time duration than wave 2. But the guidelines of wave formation, we expect to pull back to the low of the previous 4th wave at 1 lesser degree. So if this is 1, 2, 3, 4, 5 for green wave 3, we can see that price action has pulled back and even pushed down below the low of the previous 4th wave lesser degree. And even if we were to consider the wave 1 high, without getting a Fibonacci tool or anything like that, I think we've come at least down to a 38.2% retracement, if not a bit more. But wave 4 cannot end at the price surgery of wave 1. We've gone beyond the low of the previous 4th wave of 1 lesser degree. So my opinion here would be that the low of a pattern here for this green wave 4 is actually in place. So whether this is all of wave 4, of which I don't think so, because going by the guideline of alternation, this was a very sharp and deep wave 2. But if we look at the 4th wave, we have the initial pullback here. It's quite sharp. And I think it's more likely that we'll get a sideways pattern here, i.e. a triangle. If the depth of the pattern has already been satisfied, then we could be in for what may be quite a range-bound period for dollar index. That or the 4th wave is in place. This could be one. We get a pullback in wave 2, and we can be pushing higher. But for us, for the next number of years, I would still be expecting that following what would be a 5-wave advance for wave A, that we still have quite a bit of correcting to do within the dollar index to the downside, just to get the context of what we're dealing with here. So if I was to even consider putting channeling on this, we could say that, there's still more room or more expectations for this 4th wave to actually unfold. So if I just get down into the more detail then of what would be the dollar index chart from the currency pro services or whatever, I want to just highlight that, the ABC correction, that would be the ABC back to the 7069 low. And this is the 5-wave structure that we've looked at. And then the peak that we called, and then the corrective pullback that's unfolding. So even just looking at it in the context of this amount of price action going all the way back to the 1970s, we can see that the pullback from 114.78, it still seems quite brief. And we can see that the B wave that we're tracking, there's still expectations for this market to push potentially much lower, get back to 89.20. And even if this is A and B, or as I said, maybe 1 and 2, we'd still be expecting quite a deeper pullback than what we have here at the moment. This is just possibly the early stages of the correction that's unfolding here from 114.78. And that's something that we need to bear in mind when we're considering the dollar index and the US dollar pairs going forward. So here is the ABC scenario. Here is something that may be more bearish, that this could be 1, 2 of a still developing wave A. If we were to get 1, 2, 3, 4, 5, and we got A all the way down, tested wave 4, then we got wave B, wave C. But I don't like doing that forecasting with lines that price action is going to do this over the space of a decade or more. What I want to do is concentrate on what could happen in the next number of weeks to months, And I think what needs to happen here is a breakdown from this impulse channel and a test of the 89.20 low. I think the nice, sharp, and impulsive nature of the drop from 110.18 is in line with the idea that this is wave one of wave C that's still unfolding. And I think we're going to have reason to kind of keep our focus lower, and especially going by the price action we looked at there on the daily chart for the dollar index. It seems quite corrective in nature, and I feel it's a setup now that we're going to be doing to get this market down from the significant impulse channel on the monthly chart.